Are you actually choosing the right path to build wealth or just following what feels safer? Most people think they're making a smart financial decision when they pick between real estate and stocks, but they're not. They're choosing comfort over clarity. And that single decision, it can quietly cost you 5, even 10 years of financial progress without you realizing it. Now imagine this. You invest your savings consistently for the next 5 years, thinking you're doing everything right, only to look back and realize you chose the slower path, while someone else with the same money ended up miles ahead. That gap doesn't come from luck. It comes from understanding the math most people ignore. Here's where it gets uncomfortable. Real estate feels safe because you can see it, touch it, control it. But stocks feel risky because they move, they fluctuate, they test your patience. But what if that instinct is backwards? What if the thing that feels stable is actually limiting you, and the thing that feels uncertain is where real wealth compounds? I've seen this pattern again and again. People don't lose money because they picked the wrong asset. They lose years because they never understood how their investment actually grows. And once you see the difference, you can't unsee it. Right now, you're being pushed to make a financial decision you don't fully understand. And the uncomfortable part is, you feel like you have to decide quickly, before you even know what you're doing. Real estate or stocks, stability or growth, safety or speed. Everywhere you look, someone is confidently telling you what the smart move is, and without realizing it, that confidence starts replacing your own thinking. One person shows rental income and calls it freedom. Another shows a stock portfolio and calls it independence. And suddenly, you're not learning anymore, you're comparing. And comparison creates pressure, not clarity. You start feeling like you're already late, like every month you delay is money slipping away from you. But here's the hidden danger. When people feel this pressure, they don't choose the best option, they choose the most familiar one, the one that looks safe, sounds proven, or gets approval from others. That's why so many people end up stuck in slow-growing decisions for years, thinking they made a smart move, when in reality, they just avoided discomfort. And this is where it gets serious. Because the longer you stay in that emotionally driven decision, the more time compounds against you, not for you. So before we even compare real estate and stocks properly, you need to ask yourself one thing. Are you choosing based on understanding, or are you just trying to escape the pressure of choosing wrong? What if the biggest risk in choosing between real estate and stocks isn't losing money, but choosing wrong for years without even realizing it? Because here's what most people never stop to think about. You can make a good investment and still quietly lose a massive part of your financial future. And it doesn't show up as a sudden loss. It shows up as time slipping away while something else keeps growing without you. Imagine this. You spend the next 5 years committed to one path, doing everything right, staying disciplined, following advice, only to find out later that the alternative wasn't just better, it was compounding faster the entire time you were waiting. That's the part that stings. Not the loss itself, but the realization that the clock never paused for your decision. And while you were building in one direction, the other wasn't waiting for you to catch up. It was accelerating, expanding, multiplying. This is the hidden pressure no one talks about in investing. Opportunity cost isn't visible, but it is always active. And that means two people can start with the same money, make different choices, and wake up years later in completely different financial positions, not because one worked harder, but because one unknowingly bought time, and the other lost it. And once you truly understand that, you stop asking, which one is safer, and start asking something far more uncomfortable. Which decision am I making right now that my future self will wish I had understood sooner? Real estate feels different the moment you think about it. It feels real. You can picture it, walk through it, even imagine telling someone, this is what I own. And that's exactly where the first layer of bias begins. Because before any math is done, your brain has already labeled it as safe, stable, smart, almost unquestionable. You see the physical asset, you feel control, and suddenly the decision feels obvious, even before you've compared anything properly. There's also the leverage effect, which makes it even more convincing. The idea that you can control a large asset using a relatively small amount of your own money creates a powerful illusion of scale, like your money is doing something bigger than it really is. And then you add rental income into the picture, monthly cash flow that feels predictable, structured, dependable. At this point, it stops feeling like an investment and starts feeling like security you can touch. But here's where it gets uncomfortable. Notice how none of this is about actual comparative math yet. It's all emotion, comfort, familiarity, control. And if you're honest, ask yourself, are you drawn to real estate because it's truly better or because it simply feels safer than alternatives you haven't fully understood yet? Because the moment your brain labels something as safe, it stops questioning it. And that's usually where deeper financial mistakes quietly begin. But now let's slow that comfort down for a second, because what most people call safe investing in real estate is often just delayed pressure. On paper, it looks structured. You own the asset, you collect rent, you build equity. But in real life, that structure comes with something people don't fully feel at the beginning: obligation that doesn't stop. Debt doesn't pause when markets shift. Repairs don't wait for your schedule. Tenants don't align with your expectations. And suddenly, what looked like passive income starts feeling like ongoing management of problems you didn't account for up front. Here's the shift most people miss. Real estate isn't just an asset you own, it's a system you operate. And systems require attention, decisions, and mental bandwidth, even when you don't want to give it. So the control that felt so powerful earlier slowly turns into dependency on conditions outside your control. And this is where things get interesting, because many people don't realize they didn't just buy property, they also bought liquidity risk, time lock-in, and emotional responsibility. And if you're honest, ask yourself this: would you still call it safe if you had to actively manage every hidden layer behind it instead of just looking at the monthly rent number? Because for most people, the illusion breaks not when they buy, but when they finally start living inside the reality of what they bought. Now shift your attention away from something you can physically see to something most people mentally underestimate for years. Stocks don't feel like ownership in the same way real estate does, and because of that, your brain naturally discounts their power. There's no building in front of you, no tenant updates, no physical proof that anything is happening, so it feels less real and therefore less important. But here's the contradiction most people miss for years. The less friction something has, the more time it has to compound without interruption. Stocks don't require you to operate a system, they are the system. You invest, and while you live your life, companies expand, earnings grow, reinvestments happen, and value builds silently in the background. No maintenance, no management, no constant decision-making. And yet, over long periods, that silent growth becomes exponential. But because nothing demands your attention on a daily basis, most people assume nothing significant is happening at all. That's the psychological trap. We tend to trust what we can feel and underestimate what we can't see working. And that's exactly why decades pass with people ignoring something that was quietly compounding the entire time. So the uncomfortable question isn't whether stocks are risky, it's this: are you overlooking something powerful simply because it doesn't make you feel busy while it grows? But here's where stocks stop being a math problem and start becoming a psychological test you don't realize you signed up for. Because on paper, everything looks clean: compounding, growth, scalability. But in real life, your behavior decides everything. You buy a stock, you feel confident when it goes up. You feel intelligent, in control, like you finally understand how money works. But then the moment it drops, even slightly, that same confidence doesn't just fade, it flips. You start checking it more often. You start questioning your timing. You start wondering if you made a mistake. And suddenly, instead of thinking long-term, you start reacting short-term. That's usually the moment people open their phone, see a red portfolio, and decide to just get out for now, thinking they'll re-enter later when things feel safe again. But that later is exactly where most people break the compounding cycle without even realizing it. They don't lose because the system stops working, they lose because they can't stay still long enough for it to work. And here's the uncomfortable contrast most people miss. This same volatility that scares one person into exiting is exactly what quietly builds wealth for someone else who does nothing. That gap isn't intelligence, it's behavior under pressure. Because in reality, stocks don't reward perfect decisions, they reward uninterrupted time. And that's why the real question isn't whether you can understand the market, it's whether you can survive your own instincts when the market stops making you feel comfortable. Now let's slow everything down for a moment and remove the emotion, the bias, and the opinions people argue about online. Because underneath all of that noise, there is only one thing that actually matters: the real math of how wealth is built over time. Real estate often feels like it creates faster progress because of leverage. You can control a large asset with a smaller amount of your own money, and on paper, that looks powerful. But what people don't calculate early on is the cost of that structure: debt obligations, maintenance, vacancies, taxes, and liquidity limits that quietly restrict how freely your money can move. So even though the return may look attractive, part of your system is constantly being held in place by responsibilities you can't ignore. Now compare that to stocks, not because they are better, but because they operate differently. There is no physical system to manage, no operational burden pulling you back in. Your money stays fully deployed, continuously compounding without interruption or attention demand. And here's the shift most people miss. The difference isn't just returns, it's friction. One path grows while requiring ongoing input to sustain it. The other grows quietly as long as time continues. And that creates a hidden gap most people never notice early enough. Not how much you make on paper, but how efficiently your money is allowed to stay in motion. Because in the long run, wealth isn't only about what your money earns, it's about how rarely it has to stop working. At this point, most people believe they're comparing two investments. But in reality, they're protecting something much deeper than money. They're protecting their identity. Because the choice between real estate and stocks is rarely just about returns. It's about what kind of financial person you believe you are. Real estate feels responsible, stable, and grounded in something physical you can trust. Stocks feel abstract, unpredictable, and harder to emotionally justify even if the numbers say otherwise. And here's where the real distortion begins. You don't always choose what performs better. You choose what feels consistent with what you already believe about how money works. If you were raised around property thinking, your mind treats real estate as safe by default. If you were exposed to markets and compounding early, your confidence shifts towards systems you don't need to control. But once that belief is formed, something subtle happens. You stop evaluating options objectively and start defending the version of money logic that makes you feel correct. That's why two people can look at the same opportunity and walk away with completely different conclusions, not because one is smarter, but because each one is trying to stay internally consistent with their identity. And the moment that happens, numbers stop being neutral, they start becoming arguments. So the uncomfortable truth is this: you are not just choosing between real estate and stocks, you are choosing whether you're willing to question the financial identity you've been building for years. So after everything we've broken down, emotion, math, psychology, identity, you start to see the uncomfortable truth. This was never really a debate between real estate and stocks. That was just the surface level question. The real issue has always been how you behave when money stops feeling easy. Because both paths can build wealth on paper, but neither of them can protect you from yourself. Real estate demands patience through debt, responsibility, and slow movement. Stocks demand patience through volatility, doubt, and emotional pressure. And in both cases, the system only works if you stop interrupting it. But here's what most people don't realize until it's too late. They don't fail because they chose the wrong asset. They fail because they restart their journey too many times. They switch when it gets uncomfortable. They exit when it gets uncertain. They reset just before compounding starts to matter. And that creates a brutal outcome. Years pass, not because nothing was working, but because nothing was ever given enough time to work. So the final truth isn't about picking real estate or stocks. It's about whether you can survive your own impatience long enough to let any system actually reward you. Because in the end, wealth doesn't collapse because of bad choices. It collapses because most people never stay consistent long enough to see good choices pay off.